everybody. It's Wednesday, March 26th. We're approaching the end of the month. What a day. I am an associate member of T3 Trading Group, which is an SEC registered broker, dealer, and member of FINRA SIPC. You should carefully consider whether trading is suitable for you in light of your own financial condition. Position disclosure. So I got out of Tesla short, did well with it. Got out of my TQQQ short that I had overnight. It was not very big. I got into MSTR short pre-market, which ended up paying really well. I did get into IonQ and BABA pre-market as well today. Originally, I was going to get out of that IonQ below 25 or whatever, but I actually thought it traded really well given the market. And would have paid great if it wasn't for the market. So I did decide to keep some, but I'm going to be keeping a very short leash on that. And I got into Alibaba today, which I think held in great. The Chinese names held in great today. So that's kind of the update on the position disclosure. Let's talk about the market because it was a day. It was a day. SPY is closing down about 1.15%. Q's closing down 1.8%. Real smoke show there. The IWM closing down a percentage point. So not good. Not a good day for the bulls. TLT was down though. Interesting. So no real move higher on TLT on a fear trade, which is what we've seen on a lot of the down index moves. And what did the dollar do? Dollar finished positive. All right, let's discuss. A lot to unpack today. So I wasn't expecting this big of a down move today. I was not expecting us to have a legit downtrend day today, intraday. I actually was expecting us to have a quieter day again. I thought we were going to have a day maybe not as tight as yesterday, but I thought that we were going to have a day that was choppy and kind of similar to yesterday. So this did not meet my expectations. I can't be surprised to see it because look at the market move, right? We had called for this bounce to somewhere between 570, 580, and we got all the way up to yesterday's high was 576 spot 40. You know, we did a pretty good job getting up there. So after a decent sized bounce, it wasn't in a straight line, but a decent sized bounce from 550 to 575 plus, a $25 plus bounce, seeing a pivot high and seeing us come back lower really is not a surprise. The degree of the selling, though, I was a little bit surprised about. I think a lot of this stemmed from the NVIDIA headlines this morning, and I know a bunch of things were getting thrown out there, like the CoreWeave IPO that's supposed to be happening on Friday. But I really think that the thing that hit us down today was the NVIDIA headline out pre-market that China might be potentially adjusting like their electricity and environmental rules to not allow their companies to use whatever the name is of that specific NVIDIA chip that has been, for the moment at least, approved by the U.S. government to be exported to China. Because whatever NVIDIA's top of the line chips are, you're not supposed to be able to send them out. But they have a China-specific chip that I think is 13% of their revenue goes to China. So China coming out and saying that they're potentially not going to allow that anymore, and the key word is potentially. I don't think that they said with 100% certainty that's going to happen. But the writing's on the wall. The writing's been on the wall. China is doing a fantastic job with tech. For a long time, they've been a step behind us, a step behind the United States in the tech world. You can see them catching up now in a number of places. It started with the DeepSeek AI. You can see it with BYD's electric vehicles compared to Tesla's electric vehicles and the charging that's coming up. And now you can see it with the government saying, hey, we really don't need these NVIDIA chips. We can use our own that are made by Huawei and our companies. I don't think that the Chinese chips are quite there yet, but it seems like they're rapidly catching up. And I don't want to go off on too much of a tangent, but I'll just say it because I've said it in the past. This is not surprising. This is something that you could have seen coming 10 plus years ago, and it's because there have been a tremendous amount of Chinese young people who came to the United States for education. And they came here and they paid a lot of money to go to the top universities in the United States and get master's degrees and PhDs from Ivy League universities. And then we made it impossible for them to stay here. And I know a lot of these people personally. There was a time in like 2015 when I had a physical trading desk of like 35 traders, and like 26 of them were from China. It was actually crazy. They were all Chinese students who wanted to work with me to learn markets and stuff. And I know because I tried to keep them here because some of them were really good, and we made it so difficult for students who came to the United States, who went to Ivy League universities and got master's degrees and PhDs here to stay, even though they wanted to, fell in love with our culture, wanted to innovate here, want to pay taxes here. And we said, nah, we're not going to let you stay. We don't want the best and brightest from around the world to be in our country. Go back to China, make China great. And now you fast forward 10 years from when I had that trading desk that had 26 Chinese nationals on it, and you see that they're using that education that they received here to make all these technological advances. So, I mean, it started already when you got NVIDIA weakness that came from DeepSeek, because all of a sudden, hey, NVIDIA is not the only game in town and maybe you don't need to do as much spend. And now it's, we don't even really need the NVIDIA chips that you want to give us. We can make our own. And that caused a lot of weakness in the semiconductor space. NVIDIA down 6% here after hours. AMD, look at that AMD chart intraday. Nasty. That great initial uptick to then get absolutely and utterly slaughtered. AMD closed down over 4%. Moved from 116 down to below 109. AVGO absolutely destroyed, off 5%. Marvell absolutely destroyed, off almost 7%. SMCI smoked, almost down 9%. Semiconductors got absolutely destroyed, and then it kind of just hit everything else down. Because I think what the market began to see here, I think what a lot of market participants began to see here is, hey, this is the pivot high, right? We're in a weak market. We're not sure what's going to happen next. We might get a pivot high. And when we started to see weakness intraday, I think that it just was an opportunity for people that want to be sellers or they're looking for an excuse to sell to kind of just pile in. And then you saw, weakness from the rest of Mag 7. Meta down 2.5%. Amazon down 2.25%. Google down 3%. Microsoft down only 1.2%. Apple only down 1%. So they began to kind of sell off everything. Interestingly enough, the RSP, the equal weighted S&P, only finished down 0.2%. So there were some pockets of strength out there as well. XLE held in really well. XLE managed to still be green. Financials did go red, but they were holding up really well for a lot of the day. They only finished down 0.3%. So there were pockets of strength, but tech got absolutely wrecked. And I really think it just fed off of additional uncertainty that came out from that NVIDIA headline. That U.S. tech exceptionalism might not be what it once was, and we'll see in time how that ends up playing out. So bottom line here is that the market had a bigger down day today. Not necessarily surprising given the environment we're in and where we came from. The question is what happens next. So I'm actually kind of inclined to think that this move lower, while it could continue, I wouldn't be surprised to see SPY 565 by the end of the week, possibly even tomorrow. I kind of think that this is going to end up being a little bit of a fake out to the downside. Maybe we'll get a little bit of follow through, but I don't think that today is necessarily a day one after this pivot high that brings us very, very quickly back down to 550 or even through 550. I think that there is some really systematic support and some seasonality support that's going to hold this market up and create at least some underlying demand on this market on the way down, which just creates a very different supply and demand structure compared to what we saw in this initial wave lower. This initial wave lower, everybody was a seller. And especially we saw the systematic strategies selling a lot quickly. CTAs were selling boatloads of stock. Vol control was coming in and selling. Then the long onlys and long shorts were obviously coming in and selling as well. And there we had buybacks. Here we're in the blackout window for the buybacks, so we don't have that to support us. But what we do have to support us is we know that CTAs are buyers in any tape, but especially in up tape. We know that there are pension rebalance flows that create a bid at least into the end of the month, and potentially a resumption of the vol control buyers. I want to pull back up real quick this chart from Pat's note from yesterday that actually comes from Charlie McElligott at Nomura, just on the vol control buying and selling, because someone had even asked me about it earlier today. So today the S&P closed down, what was it? Like 1.2% or so, 1.1, 1.2%. Yesterday it closed up, I think, and I'm just going off memory, like 0.2% or maybe 0.25%. So this chart here gives you the buying or selling that will come from the vol control systematics over the course of the next 1 week, 2 weeks, 1 month, 2 months, 3 months, based on the average daily move. So you have like a 3-month window and a 1-month window look back on these vol control funds. So, you know, for example, I guess trying to make it sound simple, as simple as I can, if you are a systematic vol control fund and you are adding or reducing exposure based on realized volatility, with a 1-month look back, what that means is that trading sessions from 1 month and 1 day ago get dropped out. So what did we see, you know, begin to happen about a month ago is we started to see really big moves. So you're starting to see, and I'm not sure exactly which day out is a month right now, but you're starting to see like maybe tomorrow, like the February 21st day roll off, which was a really big down day. So that means that the look back of the past 1 month of realized volatility is losing a really big, I don't know what that day was down, but 2% plus 2.5% down day is what it's losing, and it's being replaced by what happens currently. So yesterday was a tight day, right? And again, these are based off of averages over the course of the next 1 week, 2 weeks, one month. So if you were to average moves over the course of the next 1 week from when this was published, which was probably the beginning of this week, if you were to average over the course of the next 1 week 0.5% up and down moves, then you're going to get $9 billion worth of buying that comes from vol control. If the average is a percentage point, then you just get, over the course of this week, 0.9. Over the course of the next 2 weeks, if the average over the course of the next 2 weeks is 0.5% up or down average in terms of the realized volatility, then you're going to get $33.8 billion worth of buying over the course of 2 weeks. If it's flat, you would get 41.1. If it's 1.5%, you could see selling over the course of the next 2 weeks. If we're getting huge moves every single day, like we had today, you actually could see no buying and you could see selling that actually comes in. So yesterday was a 0.25% or so positive day. Well, that's really good. That's, you know, if that were to happen every day, that would yield a number between this left column, far left column, and the second column, between the first column and the second column of buying. But now instead what we got is yesterday we had, you know, a 0.25% day. Today we have a 1.25% day. So just using the average of just those 2 days, and that's not enough because you need either a 1 month look back or a 3 month look back, you'd be at, you know, 0.75%. So that would be, somewhere in the middle of these numbers. And again, that's just 2 days. So we got to see what happens tomorrow. We have to see what happens the day after tomorrow. But really, starting with tomorrow's trading session, my understanding is that's when you actually begin to, for the first time, roll off some of these really big realized vol days that we actually had there. And again, that term realized volatility, for anybody that's new, all that means is how much up or how much down on a percentage basis the market closed on that day. So today isn't great for forcing the systematic bid to come in. In fact, if we continue to have days that are 1.25%, 1.5%, you're not going to get any buying that comes in from them. And in fact, we could still get more selling. But, it was a really big day today. Are we going to continue to see a percent plus movements every single day over the course of the next 1 week and 2 weeks, in which case you're not going to get any of that demand that comes in? Or can we get some more days that are a little bit similar to yesterday that'll create a little bit of an underlying bid? So that's kind of the right way to read that chart. Just going over that in a little bit more detail because someone asked about it during the day today. So we will see how that plays out. But broadly speaking, I'm thinking we got the CTAs that are coming in as buyers now. And not only are they buyers, granted they're small buyers, but they were huge sellers in this area. So that is one less source of supply and actually one smaller source of demand. But the net difference is really big between how much they were selling into this down move versus the small buying they're doing in this move. Really big difference. For vol, they were pretty big sellers at certain points in this down move as well. And now we just went over the numbers. It is possible for them to continue to be sellers, but it's I'm going to say unlikely. We would need constant, everyday, really big moves similar to today in order for that to happen. I actually think that we're going to start seeing some more tighter trading sessions, which actually means that they can give us some further demand as well. So it's another source that has flipped from being a huge supply source into this down move to a demand source possibly. Maybe more neutral. How much demand is to be seen. And then finally, I haven't seen a recent update in the number, and it's probably a little bit less now than it was, but some degree of a rebalance where there is buying from pension funds into the market into the end of the month. So you've got 3 sources of potential demand that at a minimum 2 of them are not sources of supply that were previously. A little bit more of a wild card out there, I think, is still your long short funds and your long only funds. And I'll be curious to see if we can analyze that Goldman note, that daily note that they put out tomorrow, where they say the selling was actually coming from. I'm going to assume, because it was Mag 7 taking the brunt of this, that we're going to see that most of that selling actually came from long only funds and long short funds during today's trading session. But that's something I'll probably be able to see and assess in the morning. But the bottom line that I'm trying to get across is, based on an understanding of those dynamics, I don't think that we are going to see a resumption of, at a minimum, the speed of the selling that we saw into this February, late February, early March move. Can we work our way lower? Absolutely. We can work our way lower. There is definitely a bear case to be made, and I've made that bear case. But that bear case, I think, comes more in the form of slower rotation out of U.S. stocks and into other things. Foreign stocks as an example, maybe bonds as an example. And what that would probably look like, bigger picture, for another wave of selling, would be more of a grind lower than an acceleration lower like we had seen. So today is a really big down day today, but I would be surprised if we saw, today's Wednesday, down another 1.5% plus tomorrow, down another 1.5% plus on Friday, where we end up back at, below 560 by the end of the week. I would be surprised. We do have the overhang a little bit of April 2nd, but that's still 1 full week away. So it's not like you have to make your decision by Friday and however you made your decision, you're just stuck with it for the weekend. So that's kind of where my head's at, and therefore I wouldn't be surprised if today's down move actually ends up being a little bit of a fake out. I wouldn't be surprised if we saw that there are people who are really trying to press the sell side of the market because they're like, oh my god, we have this bearish pattern here. If anybody listened to my podcast thing with Sammy and JR today, JR did a really good job of kind of drawing some technical lines here on this. I would describe it as an ascending bear flag, basically, that is potentially breaking down today, and that could bring you back to lows or technically through lows. I think that there's probably a lot of people that are out there that started to really sell today who are saying like, okay, that pattern is breaking down. Let's push it for continuation. And then there's a chance that we could tail right back up tomorrow or gap up tomorrow or have an inside day higher tomorrow, where then next thing you know, the people that were very quickly pushing those shorts might have to actually get stopped out of those positions. So I wouldn't say that I'm like a super bull, but I'm like decently bullish that bigger dips are at least short-term viable still for the moment, while we work our way through having some degree of underlying demand in this market. And that if we do get a sell-off, I'd be surprised if it's a vertical down sell-off similar to what we saw, and it's a little bit more of a grind down. Though news events always have a big impact. I really think that the only reason why we sold as hard, as heavy as we did, why we trended down as much as we did, why we're down on a percentage basis as much as we are, is specifically because of the China Nvidia news. And we'll see if that even actually comes to play or not. But the language behind it was enough to spark a sell-off in a market that is already spooked to begin with right now to bring us lower. So I think that's where we're at on the macro front. It is definitely a little bit difficult to come in and take a stand on the long side on a day one to the downside. I would like it a bit better if we could gap down tomorrow and then trade up, or get some sort of bigger downside pivot tomorrow that can create like a downside tail at the end of the day on the daily candle to come in and buy. Today for sure on the intraday, I put a lot of work in for not a lot of reward on some of the longs that I had. So I was short TQQQ overnight, but I got out of that relatively quickly, and then I actually started flipping long around TQQQ 64 at around noon or so, and that continued to trade lower throughout the day. And you can just see here with the chart I have on my executions, I battled the absolute hell out of it. I did not keep it overnight. All of the trading I did in this, my long ended up basically break even. And then Nvidia was another one. I started coming in and buying some Nvidia around 115. I had one phenomenal buy when I sized up for a trade at 114.52 that I called out. I took the offer on that. I just took the offer on a big swoop of stock because of how extended we were to the downside with this volume increasing, and the hammer candlestick on the 5-minute. It hadn't formed yet because I basically bought it lows, but eventually that hammer candlestick actually came in and was able to sell the entirety of that bigger buy into that up move. But I maintained a core position that I traded the entirety of the day. I finished positive in my Nvidia long, even though I started buying it at 115.50 and it closed at 114, so it closed $1.50 below where I bought it. I actually finished positive in it, but the amount of P&L that I finished up by compared to the amount of work that I put in was very, very, very kind of not worth it at minimal. Though of course I didn't know the end outcome at the time. I just thought it was a good opportunity to try to get into some. Obviously this was like the weakest one out there that was actually trading on the news. Eventually I came in and bought some TNA. Also made a small amount of money in that. Meta actually, even though I traded it very little, I took one buy, fully liquidated. I took a second buy, fully liquidated, never went back to it. That actually ended up being my best like day trade name of the day that I took to the long side today, just because I timed it well. Brant put me onto it at the right time. I executed it well and wasn't too greedy on it, and then got out of the way into the small bounces. So it was day one to the downside, which is really not something that you should be trying to fight on the intraday. But I guess I just have in the back of my head that I think that there should be some support structure on the way down for this market that made me think it was possible, even though it did not happen. I thought it was possible that at some point here we could get a bigger reversal higher intraday. It never happened. We got a little bit of it into the close. Thank God too, because that was enough for me to, kind of get out of that T triple Q long for when it ended up being break even into the move into the close at the end of the day, and get out of NVIDIA for a small profit into that move into the close at the end of the day. And same thing with TNA, make a very small profit on it. We never got that turnaround, and trying to buy those things was very, very hard. Other trades, I kind of talked about it enough during the day. I probably don't need to get into it. Probably one of the best things I did today was short MSTR, pre-market above 240. Discussed the reasoning behind that a couple of times already. I got back into some Alibaba today. Alibaba didn't trade great, but overall the Chinese names held in really well. Baidu finished positive. JD I think finished small positive. Baba finished red, but by not a lot. So considering what the market did, I think that those names held in really well. But they're ADRs, so they're super gappy. We'll see how they gap tomorrow. And again, I got some IonQ. It's a gross looking candle on the daily chart at the end of the day. I probably shouldn't have kept it, to be totally honest, but I'm negative in the name at the end of the day. But I traded it pretty well, honestly, overall. And even though that daily candle is nasty, if this thing could have gotten any market help, it's still my execution chart. If this thing could have gotten any market help at all today on the intraday, it seemed like it really wanted to be an awesome breakout trade, and it was just, the market was gnarly and the stock was still relatively strong compared to the market. So probably shouldn't have, but I kept a little bit, and I will manage that trade pretty tightly. And then outside of that, it was just managing my swings. And I've been talking about this for the last couple of days. As the market has been moving higher, I have been getting less and less net long. Didn't get fully to flat, still was net long coming into today. So net, my swings hurt me more than they helped me today. But compared to the exposure I had a few weeks ago, that long exposure I had a few weeks ago, if I still had that fully on today, I would have gotten absolutely and utterly destroyed. But then instead, I still had some longs on, but they were reduced, so they're not as bad into the pullback. But I had, at this point, a pretty big Palantir short. So Palantir is by far and away my best name. Had a smaller Tesla short, but the P&L on that still added up and helped out. I had the MSTR short that I put on pre-market. That P&L helped offset some of my longs. Had the TQQQ that I had overnight. Didn't keep it for a huge move, but helped offset some of the P&L on my longs. So I did finish red today, but I'm not upset by it at all, because I kind of feel like I was game plan for this. I wanted a little more to the upside, and it still could happen. I think that there's a real chance that this could be a fake out move to the downside, and we continue to chop around. We maybe even break above the high from yesterday, give us one new high, fully shake out the people that came in and shorted today, and then maybe we get more of a true pivot high. I think that that's actually a very plausible situation. But I can't be upset by having negative P&L today, because I feel like I overall managed these swing positions and managed this portfolio of swing positions just really, really well in terms of reducing that long exposure, booking a lot of profit into these up days, and building into some short exposure. And then having that short exposure made it so that my P&L today was not significantly worse than it would have been otherwise. So I'm not upset by it at all. That is all that I've got. I am happy to answer any questions that you guys have here. Pete saying my dad, MIT, I'm not sure if that means your dad teaches there or what, but has said the exact same thing about the students. Yeah, for sure. Something I've been seeing for years. AVGO killed. Yeah, Micron was better. Oh, they ended up crushing it anyway. Micron was better in the beginning of the day and only closed down 2.5%, which isn't that bad compared to the other semiconductor names. But that's because there was some news out this morning, or I don't know if it was. I don't know if it was not true necessarily, but there was like a note, an email, or something that was internal to Micron from their global head of sales or something that was positive. That was having the stock act relatively strong early in the day today. From Pete, when does the blackout end? I'm not exactly sure the date on that, but after earnings season, or really somewhere within earnings season, but it'll be after the Mag 7 names for the most part report. Probably not AVGO and NVIDIA because they report super late, but it'll be at some point after Apple, Google, Microsoft, Meta report. Technically, I think the blackout window for any individual company ends 2 or 3 days after they report earnings. But what I'm talking about is more of the broader blackout window for the S&P as a whole. So it typically starts, I think, like 3 weeks before a company reports earnings, then 2 weeks after. But when you're thinking about it from the S&P as a whole, which is the way that I think Goldman models it, they're probably taking an average. I'm not exactly sure how they model it, but they're probably taking some sort of an average of. I assume it's not just based on market cap. I would assume it's based on how much companies actually buy back of their stock, but taking an average of the average of buybacks over when companies are expected to report to come up with a blackout window. But so like, and it reduces the buybacks never go to zero, but it reduces it from in between earning seasons when there are no companies or virtually no companies that have a buyback blackout window where you're basically at 100% to I think you get down to like 30% or something like that. So it reduces that very much, but corporate demand from buybacks is a huge source of overall market demand in the modern market. They're one of the biggest buyers out there, and they're very consistent. They're buyers. One of the things I've talked about, I haven't talked about it recently, but for almost the entirety of my trading career with T3, which goes back to 2010, with a couple exceptions. One of those exceptions was that like 2021, to look at an arc, that 2020 to 2021 just insane bubble in growth names. That's one of the exceptions. But for the most part, for the entirety of my 15-year career with T3, the stock market has been shrinking. What does that mean? It basically means that there's more a reduction in the stock market of overall stock that exists through M&A and corporate buybacks than there are an increase in supply that exists overall that comes from IPOs and secondaries. And again, that late 2020, early 2021 period, I think is like the only time in my career where the market was expanding in size because they were throwing a million SPACs at us and all these crappy IPOs at ridiculous prices to just take advantage of the euphoria that was ongoing at that time. That was one of the most. That was like the most euphoric period. I didn't trade in 1999. So that late 2020, early 2021 period was probably the most euphoric period I've ever traded in my career. Yep, that's right, Rich. Tate saying that we're seeing multi-month moves in VVIX and VIX on the average true range in a matter of sessions. Okay, interesting stat. From Eli, one technical question, one psychological question. From a technical, I'm assuming this is the technical one first. What would make you flip entirely bearish, considering that you mentioned that you're still not sold that this downside move would have should have an underlying bid? And basically, like, I get more bearish as I see the data show me to be more bearish, basically. So, and I mean, that's pretty much it. Like those systematics are such a huge part of the market now. So if they're all buyers when they were huge sellers, then I'm inherently going to be less bearish. But I am also saying that it is very possible for this market to move down because they're not the only buyers and sellers. They can be overwhelmed, and they do get overwhelmed. And a lot of that I just think comes from further macro clarity. And I think that we're a ways away from getting real further macro clarity. So what do I mean by macro clarity? And these are some things I'm looking at bigger picture to build out my market expectations is, one, clarity on tariffs, but also is really more going to be, I think that we're going to start seeing that these economic numbers, like these employment reports, are going to start becoming increasingly important. I think that we'll see what happens, and my thought process adjusts all the time. But I speak about this sometimes. One of the interesting things over the course of my career is how certain economic numbers gain and lose importance over time. Like, honestly, most of my career CPI didn't matter. Like, the 2010s, the biggest issue was that inflation was potentially too low. And when the CPI number would hit, it was never like a hugely market moving number that anybody cared about until inflation went to 9%. And then all of a sudden, it was the number. It was the number. Employment didn't matter as much. It was all about the CPI and the inflation numbers. And then, another thing that we see a lot that changes is good news, or is good news bad news? Is bad news, or is bad news good news? And obviously what I mean by that is we go through certain periods in the market where bad news is perceived as good because you get a higher probability of Fed intervention and Fed cuts. I think that right now with the Fed saying that they're paused, that we are in a situation where good news is good news and bad news is bad news, and we are waiting on some interesting variables that are going to be hitting over the course of the next 3, 6, 12 months. One is on the employment front. We haven't really seen the government layoffs in the employment numbers yet. And then 2 is, do those government layoffs lead to layoffs in the private sector or not? It's a big question mark right now, and I don't have a good read through on that myself at this point. But I can tell you the concept behind it. So the concept behind it is, let's say you're a government worker in Washington D.C. and you go out and you buy lunch every day, and now you just lost your job. Now you're not going out and buying lunch from the deli anymore. So the deli needs one less worker, and they let go of that worker. That's an example of how there could be push through on government layoffs into private sector layoffs. I don't know if it's going to turn into that or not. I haven't, and any research that I've read that has even mentioned it also says that it's just like a level of uncertainty. We don't know at this point if there's going to be follow through from government layoffs into private sector layoffs, but that's going to be a big number to pay attention to, and I think that the employment numbers are going to become increasingly important, and more people working, good news is going to be good news, and less people working and misses of expectations is bad news is going to be bad news, and then the other one is going to be growth. What are the growth read-through numbers going to be looking like? Because you're not seeing yet, maybe a little bit just in terms of like consumer confidence numbers. Like maybe just there's more uncertainty out there right now because of tariffs and because the stock market pulled back, so consumer confidence has gone down. But you're not really seeing any potential impact that may happen from things like tariffs or things like these austerity measures into those growth numbers yet. So it's an ongoing thought process as we gather more data. So to circle back and more directly answer your question, what would make me flip entirely bearish when I'm probably a little bit more neutral? I think the best way to describe me right now is neutral, or even you might even be able to describe me as neutral bearish, but not full on and entirely bearish. It would be just a combination of seeing the market dynamics become more bearish and also seeing the data, the economic data, continue to weaken. Because I think that it's like I said, you can have the market go down and be supported to some degree by pension rebalances and CTAs and vol control, have them be buyers, especially if they're only small buyers. You can still have the market go down in the face of that because other flows can overwhelm it. But I think that what that looks like in the actual market is more of a grind lower as opposed to an acceleration lower. I also just saw a statistic that I can't quote directly. I don't remember exactly what it is, but historically speaking, the speed of 10% corrections, and I know that this one was especially historic. This was the fifth fastest correction since 1950. But historically speaking, moves from all-time highs to corrective territory of 10% are typically actually much faster than moves from 10% down to 15% down. That's just an extra historical statistic which doesn't necessarily have to apply in any future situation, but that's just an additional historical statistic that I think also backs up the idea that if we continue lower, it's not us continuing lower 2.5% per day at a time. Maybe it accelerates into a full-on fear trade at a certain point if you start to get retail to really sell, which we haven't seen that yet, by the way. Retail has primarily still been buyers in this down move. If you get retail to begin to panic, then yeah, maybe you can start to see consistent 1.5%, 2.5% down days. But without that, I think that any move lower at this point, if it comes, is a grindy down move lower where eventually maybe we make new lows. Eventually our 10% correction becomes a 15% correction. But if we were able to go down 10% in, I don't know, 3 weeks, I think that us being down 15% might be a couple month move, if that makes sense. So appreciate the question. On your second question, a little bit off topic. In your earlier years of trading, did you ever find yourself comparing your performance size to your mentors, colleagues? And what advice do you have to give to guys in the first few years about that? I was generally pretty good at not doing that for the most part. I'm not going to say never, but I was generally pretty good at not being influenced by the P&L of the people that were around me. But I can tell you from having managed traders on a physical desk for 10 years that what you're describing is a fairly common thing. And especially guys that are competitive, which I know you are. Your brain just wants to think that way. This is not a competition amongst us. We're a team. So instead of thinking about, wow, this other trader trades so much bigger than me or makes more money than me or whatever it is, and it's a competition where I want to be that big and I want to make that much or be even bigger and make even more. Think about it instead of a competition. Think about it more like a team, where you don't have to be the top point scorer on the basketball team. It's great if you're the top assist leader, because we win the game, and winning the game as a team is all that actually matters. Whether, I got 50 points and you got 20 points doesn't matter as long as the team itself is getting the W. That's the right way to think about it. Um, putting yourself into a position where you're swinging P&L that you're not ready for yet is a great way to lose money. When traders have P&L movements that they aren't ready for yet, they make mistakes. They deviate from their game plan. They sell too early. They won't take that loss because, oh my gosh, that number is just too big. I can't let myself realize it. And then they make that number into something that's significantly damaging to themselves. So it's really important that you trade in a way that's appropriate for where you are in your career. And I'm a really big advocate. I know we've spoken about sizing up in the past. The right way to size up is to size up in a small but incremental way over time, preferably based on positive results, where you want it to be so that you go from swinging $500 a day to swinging $5,000 a day. You want that to occur, but if you do that overnight, you're going to hurt yourself. You want that to occur because you went from swinging $500 a day last month to swinging $550 this month to swinging $600 next month to swinging $700 a month after that, where you're doing it so small that like that next thing you know, a year plus later, maybe you are swinging that $5,000 a day, or maybe 3 years later you're swinging that $5,000 a day instead of 500. But you did it in such a way where, from a trading psychology perspective, you almost don't even realize it until I know for myself, every once in a while I step back and like I have really big P&L swings at this point, and they tend to not bother me at all because I incrementally got to this level of swings over the course of 15 years of doing this. But every once in a while, I step back and I might say to myself, like, holy cow, I just lost a down payment on a house today, or something crazy like that. I could have bought a car today, whatever. And then I go, wow, that's really crazy. Does it make sense for me to be swinging this big? But then I remember that this is just my business, and I get back to just focusing on it as a business that has performance, and I make money and I lose money, and just need to make sure that the trajectory continues to go in the right direction. But even for myself, I would argue that my swings this year have actually been too big. So I need to work on reducing a little bit. They've been too big. But yeah, I think that covers the answer to both of your questions. I appreciate them. They're both great questions. Popping over to the YouTube. I need some yield max Derrick 3x daily bull shares. Not sure I fully get it. I'm not sure if it's an ETF on me or if it's a dividend ETF, but yeah, for sure, I need it too. Yeah, everybody wants an immediate pivot. I don't necessarily think it's coming. From Liam, thoughts on JD? I like JD. I like JD. Baba has proven to be a little bit more of a leader. So that's why I went back to Baba first. But into the initial up move, I had Baba, I had JD, I had Yin. At certain points, I had Tiger, I had Futu. I do like Baidu. I don't know why I haven't been in Baidu really at all. I like Baidu a lot as well. But I think that Alibaba has been the biggest leader in the space overall. So that's why I'm in it. But I like them both. They both have really cheap multiples, have growth, and have great buybacks. That's a combination that I love. The risk side, and part of the reason why a bear would argue that they deserve to trade at those lower PEs is because there's inherently additional risk in owning a stock that is based in China compared to the United States, and just the way that the government runs and everything like that over there. But I would also argue that risk can also mean more reward. But yeah, I'll just kind of leave it at that. So you're thinking it's less likely that we fill the gap. No, I'm not necessarily thinking it's less likely that we fill the gap. The gap in the SPY is only down to 565. We're at 568 right now. It's only $3 lower. We could easily fill that gap. We could fill that gap, find some support there, tail back up, reclaim 570. The very, very, very short term, I'm not 100% sure. I just don't think that we're going to accelerate down the way that we did, and I think that there's a chance that this is a fake out move. How, when, and if it becomes a fake out move, what that looks like, you could get a second day down. You could overshoot my expectations, get us to 562, and then create a pivot low. Or maybe we just gap up tomorrow, give an inside day, and it's an inside and up, and we get some positive news or something like that that pushes us higher as well. I'm not 100% sure, but this gap is a hair away. It easily could get filled. How much do you think that the ex-dividend impacted the gap up? The ex-dividend was $1.69, I think, and it happened on the morning of the 21st, so it has zero impact on this gap. The impact that it has is that SPY 570 is not the same as this SPX 5700. So you would think that 5700 is the previous level of these tails that we have been looking at. SPY 570 was same deal, the previous tail highs that we were looking at. But if we closed at 568.30, we basically closed at 570 today, because again, I think that ex dividend was $1.69. So you have to calculate that in. The more the time that goes by, the less that this matters. But it matters in the initial couple days when the ex dividend occurs, because the levels in the ETFs are a little bit off. So in reality, it may look like we really breached this previously important resistance of 570 today. In fact, we actually kind of closed right at it. And again, you can see that with the SPX. How do you manage having so many open positions, multiple screens, and why do you prefer to trade multiple names versus a couple? And how long have you taken that approach? What lead you to start that? Sure. So it's a good question. Basically, the question is, why are you in so many stocks, and why not be a little bit more concentrated and focused? When I was a new trader, when I first started trading, I had to create a rule for myself that I would not allow myself to be in more than 3 positions at a time. Because I found that once I was in more than 3 positions at a time, I started to make a lot of mistakes. I just couldn't handle it. I would have game plans and everything, but I couldn't keep up with my game plans. I couldn't follow all 3 of those stocks at once. So I noticed that once I was in more than 3 positions, it would start to negatively impact my performance. And I created that rule: I shall not be in more than 3 positions at a time. As I gained more experience, I just became better at and more comfortable managing multiple positions at once. So it really just is an experience thing. And if you fast forward 15 years, I know my game plans so well with my trades that I'm in. I know when I get filled on a bid or an offer, and I need to put out a bid or an offer, I know exactly where those bids or offers need to be without thinking of it. I can be now in 25 positions and be on the phone, having a phone call with somebody, or answering an email, and be able to manage those 25 positions for the most part without losing a beat at all. That's entirely experience. I'm very, very fast on my hotkeys, which are super important to trading. You got to have good hotkeys. You got to know how to use them. TO, the human Python code. I'm just really, really fast on my keys. I know exactly what my game plans are, and it's not a problem for me to manage them until sometimes I start getting to 30 plus positions, especially in the beginning of the day. If I have aggressive game plans, I actually am finding I can't handle it. And I actually am finding that that is my absolute limit. I don't think I'm going to be able to get any faster at this point than I already am. Um, I pound the hotkeys faster than anybody in the business, anybody who can do it, I think, genuinely. And I have started to find that, specifically right at the open, that first 15 minutes of the day, if I got too aggressive game plans and too many positions, I can't keep up with it. So I might be at my capacity. I got some thoughts in the back of my head of some things I could potentially do if I want to be able to grow further. But I'm not concerned about growing further right now. If anything, I'm concerned that I'm too big and my P&L swings are too big, and I'm trying to cut back. So I gotta figure out a way to be able to do a better job of that. So that answers that question. And why do I? So I prefer to have multiple names, especially because I'm doing so many swings. Like, let's just say I'm gonna make up some numbers. Let's say I've got $5 million of positions on right now tonight. That's spread out over 30 positions. Let's make it even easier. Let's make it $3 million of positions of exposure, totally speaking, spread out over 30 positions. If I were to take that 3 million of exposure and put it into 3 positions, I'm opening myself up to a lot of worse risk on news that could happen to an individual stock overnight is one. And I like having some diversity of sectors, even though I tend to be a little concentrated in tech. I like having some diversity of sectors because I tend to be concentrated in things that are higher beta and higher moving because generally speaking, movement and volatility pays me. But I love the fact that I'm talking about how my shorts saved my butt a little bit today, but my shorts aren't the only thing that saved my butt today. VAL saved my butt a little bit today. I have a big position in VAL. VAL is up 2% today in the face of this market down move. VAL is my third best name P&L wise today. BYON, I don't have a huge position in it, but BYON was up 9% today, and I'm long that name. What if I only had 3 positions on? And don't get me wrong, I have other positions that got absolutely smoked and are much worse in the market. TTD was down 5% today. NBIS that I'm long when circuit broken today was down over 10%. But the bottom line is that it just kind of diversifies that risk out a little bit, and for me, it's just a better way to do it at this point. So I hope that helps. From JFF, if you start to compare yourself, you're not properly implementing risk skew. Yes, that's I think a comment to Eli's question earlier. From Kevin G. Kevin G goes, I'm a great teammate. I average the most amount of time on the bench. Robert says, I'm a key team player. I'm always carrying keys from the changing room. Thanks, guys. From Steve, any thoughts on GME buying Bitcoin at a $1.3 billion convertible bond? The whole thing's a scam. They're all running this scam. And my biggest thought process on GME doing this is that it's a negative read-through on MSTR. That's my biggest thought process. And man, I would love for them to just crush Bitcoin. Not even because I'm against Bitcoin itself, but because I really want to see these schemes implode. Why don't we just have every company in the S&P 500 start to issue convertible bonds to be able to buy Bitcoin and run the exact same scheme that is going on in MSTR? It can't possibly work in the long run. It would create just the wildest bubble at a certain point. It probably would work in the short run. It would work for a while. Probably would see Bitcoin go to some insane number. But then I think it would absolutely and utterly implode on itself at a certain point. From Liam, do you use any of the very common indicators like RSI or MACD, or are you not a fan? Also, I know I asked previously What time frames are your EMAs? I'm my everything I do is relatively simple. I look at Japanese candlesticks, volume, and moving averages. Particularly, I like to look at an 8 and 21 EMA on every time frame, and on daily charts, a 20 and a 5200 SMA. I don't look at anything else. Um, but I don't fully discount indicators either. And I pay attention when the team of traders I work with provides information on any of them, particularly the RSI. I like when we're seeing a stock get smoked and I'm considering buying it, and then I see Tate or Pat or someone say the RSI is at 5 or something. I'm like, oh, that's an extra piece of information that's important for me. So I'm not against them. I know Pat likes to use Bollinger Bands, Ichimoto Clouds, RSI. I just think that traders, especially newer traders, can become overly reliant on them. And everyone needs to remember that all an indicator is exactly what it says. An indicator indicates something. It is not the be all end all. You will find examples of every indicator that exists fail. Um, and yeah, you got so it's an extra piece of information. It's an extra layer of probability, perhaps, for when you like other things. But I like the idea of new traders keeping it very, very simple. Um, and then after once you can learn to read the charts and the price action, then you want to add on your RSI, go for it. But I think that you want to start by really learning to just read the price action before you add in that other stuff. Are your hotkeys a combination of control plus shift plus a key, or do you have separate keyboard with custom? I just use the F keys. Many people recommend that you have to press shift and then the key or whatever to eliminate like you drop your coffee cup on your keys. I don't actually do it. It's just my F keys. And it's wild. I can't even tell you what they do when I look at them. I actually have to use my fingers. So yeah, my F6 is bid, my F8 is offer, my F1 is uptick, my F12 is downtick, my F2 is no, it's not, is it? My F3 is my buy stop, my F11. Oh, that's weird. I'm just noticing this for the first time. Is my sell stop. But you don't want my hotkeys. You want Pat to, Pat typically gives a layout to new traders when they first get started. That layout includes hotkeys. Just learn to use those hotkeys. Don't worry about what mine are. I'm sure Pat's system is probably better than mine, honestly. I just have been using my buttons the exact same way for so many years that if I were to change things now, even though it might make an improvement, it's just going to mess me up mentally. So I'm not going to do that. Yeah, I also don't think MSTR makes sense long term. Forbes magazine curse. You don't utilize dead cat sleeping in the bushes playing with the yarn pattern. No, I don't use that one. I don't use VWAP either. I don't use VWAP on my charts, but it's another one. I like VWAP actually, even though I don't use it. I think it's an important one because a lot of institutional buyers and sellers have to manage their performance based on the VWAP, and there's a lot of algorithms that are very simple. They're just execution algorithms that are buy on the VWAP or sell on the VWAP. And other people use like an average VWAP or like a weighted VWAP. So I think it's a good one, but I also don't use it personally. Yeah, Josh, don't listen to anything Josh says about how to buy or sell. The guy uses a mouse for point and click and only takes liquidity. It's such a performance drag. It's wild. But people get stuck in their ways. I am so confident that if Josh would just listen to me and make some adjustments on how he executes, that he would make more money. But Josh has been doing this for a long time, and you're not getting me to change. I've been doing this for too long. I don't want to change my software. I don't want to change my buttons. I don't want to. I don't want extra indicators in my charts, even if I think they could be important. Um, what I have works really well for me, so I don't want to adjust. And Josh is probably the same way a little bit, but I'm so confident that Josh would make more money if you listen to me a little bit more on execution stuff. Back over into the VTF. I feel like I missed something. From Pete, do you have a snapshot or something of how you do you have a snapshot or something of how you have your hotkey set up? I don't, but like I was saying before, off of somebody else's question, um, the setup that you can get from Pat for hotkeys is better. You just want to make sure you want to have um, bid offer, so buy limit, sell limit. You want to have buy stop, sell stop, and then maybe market buy, market sell. I prefer more like an uptick or a downtick, but it's very very similar, and that's it. Um, yeah, I probably should have. That'd be a good idea. The one thing I should have is some safety on my escape key. Because on that rare occasion that I accidentally, a couple times a year, I know I did it one time recently, right before I was about to have to do the morning meeting. I was putting down a cup of coffee, and for whatever reason, I just missed where I was supposed to put it down, and it caught my escape key on the way down and canceled all my orders. It was a nightmare. I know Pat's dying for me to just get rid of that key entirely, but I want to have it in case I don't know, the nuclear bomb goes off or something. Paralysis from analysis. On RSI, do you like to see a high number versus the market, or do you look when it is 30 and below, which often coincides with capitulation? I don't know. That's a question for Pat. Pat uses the RSI. I just pay attention when somebody else says something. But I feel like when I care about it is when it's below 10, or at 10 or below, or at like 87 and above, not at 30. And what Pat I know will tell you is that he only cares for it on small time frames, like a 5-minute chart or maybe a 15-minute chart, and not on daily charts. Yeah. From tape, I keep the F keys separate in sets to help prevent fat fingering, keeping F1 to 4. Yeah, I kind of have it. I kind of have it that way. My buy and sell buttons are kind of far away. I mean, the buttons I use most are F6 and F8, which are bid and offer, and I guess those are kind of close to each other. It's probably not the best setup, but like I said, don't get the setup from me. I am terrible at computers. I'm terrible at software. My keys probably aren't the ideal way for them to be done. They're definitely not. But I'm not changing them because it's unfortunately, and I feel bad about it moderately. When I'm on this specific computer setup in Idaho, this keyboard I'm on is very fast, but it's also loud. So you probably hear, especially in the beginning of the day, me just absolutely pounding on those keys, especially at the open. So you hear how fast I'm pressing those buttons. Like when I like I said before, when I look at them, I don't even know what's what. I have to actually be trading to really know what's what. And if I were to change them now, it'd be a disaster. I bet Pat's faster than you with his hotkeys compared to your point and click. Just seeing your comment there about challenging anybody. I bet Tate is too, to be honest. He's just he's like a young gamer, and you're just old and eat too many hamburgers. Kava to be added to the S&P 400. Scrolling through here on the commentary to see if I missed any questions. Doesn't really look like I did. Just some commentary. Painted my F keys with nail polish. Yeah, people used to do little things um, tape over little pieces of paper on their keys that said like what they were and stuff like that. People used to do stuff like that in the office. Um, I don't know. Do whatever works for you. I mean, I remember they told me when I was a brand new trader. When I was a brand new trader, keep in mind it was a very different market environment. They taught me to day trade by scalping, almost entirely tape based, no charts. So it was a lot of like front running large orders and stuff like that in the market, and it was all about how much money you made was all about how fast you were. Speed was so important with that style of trading when I first started in the business. What they told me to do, and I never actually did this, but it just gives you an example, uh, is to basically take a keyboard home with you on the subway and then sit there on the subway and basically close your eyes and press the buttons and imagine that you need to buy, imagine that you need to sell, and just be pounding the keyboard basically on the subway with nothing connected to it, just to get used to using your hotkeys and getting fast. And again, I never actually did that, but it was something that was suggested by more experienced people to entry level traders. To me, it sounds like a great way. I was gonna say it sounds like a great way to get robbed in the subway, especially in this day and age. But they probably would think that you're such a nutcase if you're there just with your eyes closed, with a keyboard in your lap, pressing buttons, that maybe nobody would mess with you. I haven't really heard of CoreWeave until recently myself, but all right. Looks like I got through everything. Long afternoon meeting today. Some great questions. So have a great night, everybody. I will see you all tomorrow. And if you're in YouTube, you know what to do.